Reverse mortgages are something that I've really not gotten into, and the history I've heard from clients and people that have, it's usually not really a positive thing, so I've kind of steered away from them over the years. But lately I'm hearing there's some changes, they're getting over the growing pains, and actually I'm starting to hear some really great opportunities that they can provide. And so if I can get opportunities for my customers and clients, I'm all in. So we've got one of the experts, Mary Jo Lafaye. So my first question would be, what happened with reverse mortgages that got such a bad rap?
That's a really good question, and I do a lot of public speaking and seminars, and that's usually where I start, because there are a lot of misconceptions, and they're well-founded misconceptions. Reverse mortgages used to be actually called reverse annuity mortgages, and they were done by insurance companies. They weren't really a loan, they were an annuity product, and the insurance company would require you to take a large lump sum draw loan from them. Interest rates at the time were about 13%, so that was part of the problem. In addition to the high interest loan, you would have to take that money and use 100% of the proceeds to buy an annuity from them. So there was profit on the loan and there was profit on the annuity, and then in addition to that, the insurance company also was then entitled to half of your future appreciation. So those programs are completely gone. There may be a few of them still in place, but they're not being offered anymore. I think they've been gone for about 10 or 15 years.
That sounds more like a partnership,
It was more like a
participating
partnership,
mortgage,
exactly.
real estate development kind
Yes.
of deal that we used to put together.
That's correct. Yeah, there were a lot of different facets to it, and it was hard to understand.
I'm already lost.
Yeah, and if you lived in the middle of the country, there wasn't a lot of appreciation oftentimes, so it wasn't quite so egregious. But if you lived on the east or west coast, you may have had $500,000 or more in appreciation during the term, and then that would be money that your heirs did not get. They didn't get half of that because the insurance company received that. So FHA came onto the scene in 1989, and they created what's called the Home Equity Conversion Mortgage, and today we refer to that as a HECM, H-E-C-M, Home Equity Conversion Mortgage, and that works similarly to a line of credit that you would get from your bank.
Like an equity line.
An
People
equity
go
line.
down and draw $100,000 to remodel or buy a boat or
Right. So a
vacation.
conventional HELOC, they call it a home equity line of credit. They're offered by most banks. The downside to those is that you have to qualify for them. So they look at income, credit, job stability, those type of things, and you have to make a payment. So you're paying initially. There's a draw period. That draw period usually lasts 7 to 10 years. And during that time you make an interest-only payment, and then the loan recasts. And when it recasts, the draw period's gone, so you can no longer draw from it. But then you have to start making a principal and interest payment. So essentially it becomes a second mortgage. And if you're young and your income is growing and you just need money to buy a car or send your kid to college or remodel your kitchen, it might be a great solution. But if you're needing money to support yourself throughout your retirement, you want something that's more open-ended and that has more protections that are specifically designed for seniors. So the FHA insures the home equity conversion mortgage specifically as a retirement tool to help seniors access their housing wealth and not have the obligation to repay it for as long as they live in the home. They do have other obligations. They have to pay their property tax, homeowners insurance. If there's a homeowners association, they need to keep those dues current, and their maintenance and utilities.
So this is something good for someone that's sitting in their home. They don't want to leave their home. They're equity rich but cash poor.
Exactly.
This is something they might consider.
Yeah, and not all of them are what I would call cash poor. Some of them may have $800,000, $1.5 million invested. But the current rule, if you look at some of the academic researchers, like Wade Pfau wrote a book on reverse mortgages. He's a professor of retirement income at the American College. Jane Bryant Quinn has a book. So we have a lot of academic research being done right now. And the safe max, what they consider a safe amount to draw from your portfolio, your investments during retirement, if you want them to last 30 years, is about 4%. So if you have $1 million invested, that's about $40,000 a year you can draw. If you're used to living on income of 100 or 150, and now you retire and you can only draw 40 plus Social Security, that's going to hurt a little bit. So what they recommend is that you have this, if you need to supplement your income, you have this line of credit. You could supplement your income without worrying about, oh no, when is it going to turn into a payment?
Right.
Or, like we just had a big drop in the stock market, if your investments go down, let's say your investments go down to $800,000, you can still only draw 4%, so now that's $32,000. You were able to draw 40, now you can only draw 32. So during those times, you can fill in the gaps with this line of credit, and your investment portfolio will most likely grow over your retirement instead of shrink.
Sounds good. Where do I sign?
Yeah. So, well, you have to be 62.
Okay.
So, and you have to live in the home. So it does have to be your primary residence. And you have to show that you have enough income to pay your property tax, homeowners insurance, maintenance and utilities, and HOA dues, homeowners association, if you have a homeowners association. And other than that, it's really pretty easy to qualify. The loans take about 30 to 60 days. There's an appraisal required. And then you get to live in your home for the rest of your life with no repayment of the loan.
This is more like an equity line that they can just draw off of.
Right. And if they need to draw at all, probably about a third of my clients come to me because they're in retirement or they're trying to figure out how to afford retirement and they still have a mortgage payment. So if you're 65 or 70 and you're still paying $2,000 or $3,000 a month, that's probably going to prevent you from having a comfortable retirement. So in that case, we can use the HECM, pay off their existing mortgage, and if they're taking all the money at closing to pay off an existing mortgage, they can get a fixed interest rate. So that is a guarantee that their interest rate won't go up for as long as they live in the home. It's an open-ended term. It's actually up to age 150. So when you vacate the home, move, sell, or pass away, or if you reach age 150, the loan is due. And at that time, probably you will have had significant appreciation by then, and so your heirs will inherit the property at the fully appreciated value, and they just have to pay back whatever you borrowed plus the interest that accrued, and all the rest of the appreciation and equity goes to them. Yeah, and they can sell or refinance or however they want to handle that. And our new jumbo loan has a $4 million loan amount.
Wow.
So for those high-end buyers, if you want to buy an $8 million house but you only have $4 million, I can provide the other $4 million. There you go. Yeah, so there are a lot of differences in the way the loans are today from what people may have a misconception. A lot of people come to me and they say, I really need an extra few thousand a month, or I need you to refinance my conventional mortgage into a mortgage with no repayment, but they say, I don't want to sign my house over to the bank.
Right.
Well, that's not a problem because you're not signing your house over to the bank, you're just securing the loan with your property.
Makes sense.
Yeah, so it's very similar to a HELOC with a lot of different protections and different
kind of reverse. It works in a backwards way more than a reverse mortgage.
Yeah. Yeah. So the old reverse annuity mortgages, those had the annuity and the equity appreciation sharing. This is just a loan with deferred repayment.
Okay.
So the repayment is deferred until what they call a triggering event, till you move, sell, pass away, or if you quit paying your property tax and homeowners insurance, then the loan's due.
Would that be sort of like a negative amortization loan?
Mm-hmm. Okay. It is. Yeah, and even negative amortization loans got a bad name because people would, the interest would accrue and then they would owe a big payment. They'd get a big monthly payment that they couldn't really afford.
Right.
But with this, even though interest is accruing and your debt is rising, typically your house is also rising in value. But the key is that you never have to make any monthly repayment as long as you live in the home and pay your property charges.
Well, because they've got the shelter of the
Right.
equity there already.
They've got built-in equity and they have FHA that's insuring it. So
Okay.
it's what's called a non-recourse loan. So there's no personal liability, only the home is liable for the debt, and if the home runs out of equity, then HUD is liable for the debt. So it's a big difference. There are very few loans in California that you can refinance into that are non-recourse, and the reverse mortgage is one of them.
And so, Mary Jo, how do we get a hold of you?
So I'm pretty easy to find. My last name is Lafaye, Lafaye. And so if you just Google Mary Jo Lafaye, you will see a lot of information. I post regularly on my blog, which is 62cashflow.com, and I post all the current academic research being done by the different wealth management advisors, the Boston College Center for Retirement Research, Dr. Wade Pfau, Dr. Barry Sachs, Texas Tech Wealth Management University. They're all doing a lot of academic research to see how we're going to help seniors stay in their home and afford to have a reasonably comfortable lifestyle and some dignity, pay for care, and so forth. So I post all of that academic research on my blog at 62cashflow.com, and you can call me. I'm local here in Marin County, 415-259-4979.
And if you haven't noticed, just I got to point out, here's the famous Santa Fe mission back up here in Santa Fe Hill, and if you had a mirror, you could see my house is sitting right down there.
Right.
So anyway, and this is the penthouse of the biggest building in Santa Fe, so she must be doing something right.
Yeah, so I've been in the field for 15 years, so it suits me well. I enjoy working with seniors and
Good.
their
Well,
advisors.
I'm looking forward to seeing this in action. I think it's a good tool and a good opportunity for some, maybe not everybody, but there's certainly a lot of people out there that could probably take advantage of this. So
Great.
take care.
Thank you.